Looking for great deals on great stocks? Like the idea of one day living off of the safe, growing dividends your investments provide for you? Interested in knowing about dividend growth stocks that have become way cheaper after dropping big time? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, if you want exclusive access to my personal six-figure stock portfolio and alerts on any new investments I make, check out the Patreon link in the description below. Investing successfully over the long run is simple, but also difficult. It's simple to say that you need to ignore the noise and take advantage of market volatility when it comes. But it's difficult to actually do that in real life. Well, I think dividend growth investing makes this a lot easier. Dividend growth investing is a strategy whereby you buy and hold shares in world-class enterprises that pay reliable rising dividends to their shareholders. We're talking about some of the best businesses in the world here. And it's this combination of growing passive dividend income and business quality that makes it so much easier to take advantage of market volatility. See, growing dividends pay you through the volatility, making it easier to hold on. Plus, all else equal, price and yield are inversely correlated. So that means lower prices result in higher yields, which means more passive dividend income on the same invested dollar. Getting paid even more to hold on? Yeah, that'll help. And the quality of these businesses helps to build confidence through the market volatility. If you're highly confident that a business will be just fine because it's been just fine time and time again over the course of decades prior, that makes it a lot easier to jump in when things are getting a little bit crazy. Today, I want to tell you about 5 dividend growth stocks that are down 20% or more from their recent highs. Ready? Let's dig in. The first dividend growth stock I want to bring to your attention today is Fidelity National Financial Inc., stock ticker FNF. Fidelity National is a title insurance company with a market cap of $10 billion. Fidelity National isn't just a title insurance company, it's the largest title insurance provider in the USA. In a highly fragmented market, they're the clear market leader. And what a market to be a leader in. Most Americans want to own their own home, and guess what? They usually have to finance that house because almost nobody can afford to buy a house in cash. Well, if you finance, you must have title insurance. Talk about a captive customer base. Plus, there are almost never any claims against the title insurance. So the float just grows and grows and grows. This is why Fidelity National continues to do so well through the ups and downs of the housing market, increasing its dividend along the way. The insurance company has increased its dividend for 11 consecutive years. The company's 10-year dividend growth rate is 12.6%. That's solid in and of itself, but it's made to look a lot better when you see that it's paired with the stock's market-smashing yield of 4.8%. This yield, by the way, is 140 basis points higher than its own 5-year average. What an incredible spread. And while the housing market is definitely cooling way down, Fidelity National has been here before. The company's been around for 175 years. Meantime, with a payout ratio of 27.7% based on trailing 12 months adjusted earnings per share, the dividend is protected even in a challenging environment. In fact, the company increased the dividend yet again in November. Talk about big time. This stock is down 31% from its 52-week high. The 52-week high of $54.25, yeah, that's long gone. Shares are now priced at roughly $37 each. What a difference a year can make, right? A lot of big drops in the market, they can be justified. That's because many stocks were vastly overvalued before the drops occurred. I don't think that's the case here, though. In my view, this business went from reasonably valued to downright cheap. The price to earnings ratio based on trailing 12 months adjusted earnings per share is only 5.7. Whenever I see a single digit PE ratio, I know a lot of bad news is being priced in. The price to cash flow ratio of 2.3 is nearly 1/4 of its 5-year average of 8.6. The stock's price is similar to where it was in the summer of 2020 when we were dealing with a global pandemic. Fidelity National is very, very interesting here. Take a look. The second dividend growth stock I have to cover today is Fortis Inc., stock ticker FTS. Fortis is an international diversified electric utility holding company with a market cap of $19 billion. Utility businesses tend to be great for long-term dividend growth investors. That's because you're essentially betting on people's continued demand for electricity. And I'd say that's a pretty easy bet to make. Not much of a gamble there. Also, utility stocks tend to offer higher yields. When you combine the predictability of the business model, which often leads to smooth revenue, profit, and dividend growth, along with the higher than average yields, you've got something pretty compelling. The utility company has increased its dividend for 49 consecutive years. What a track record. That's one of the best dividend growth track records among all utilities. Now, that is in the native currency, which in this case is Canadian dollars. That's because Fortis is based out of Canada. The currency exchange rate fluctuates, so the dividend paid in US dollars can also fluctuate. Nonetheless, very impressive. The stock yields 4.1%. The dividend has compounded at an annual rate of nearly 6% over the last 5 years, and Fortis is guiding for 4% to 6% dividend growth to 2027. If they get to that upper end of guidance, you're looking at a very nice mix of yield and growth here. The one knock here is the payout ratio at 84% based on trailing 12 months adjusted EPS. That's a bit high for my liking. This stock is down 22% from its 52-week high, and it now looks more attractive than it has in years. The stock's price of right about $40 is way off of its 52-week high of $51.66. This was a $44 stock before the pandemic hit, so we're about 10% lower than even that, despite the fact that Fortis has grown the business and dividends since then. The reason why I'm familiar with Fortis is because they acquired two businesses I was previously invested in, UNS Energy Corporation and ITC Holdings Corp. I know those were both great assets, which gives me further confidence in Fortis as a whole. Most basic valuation metrics here are basically right in line with the respective recent historical averages. The revenue multiple of 2.5, for example, is barely lower than its own 5-year average of 2.6. To be honest, Fortis has almost always looked just a bit too expensive to me, but this is a rare moment in time in which it doesn't. Keep an eye on this one. The third dividend growth stock I have to bring up is Home Depot Inc., stock ticker HD. Home Depot is a multinational home improvement retailer with a market cap of $327 billion. Home Depot is the world's largest home improvement company, so we have yet another market leader and yet another housing play. And why not? Anything touching housing has been trounced this year. But here's the truth of the matter. People always need a roof over their heads. Shelter is a basic need in life. Going beyond just basic needs, though, most people like to own that shelter and call it home. What does that involve? Plenty of maintenance, repairs, and upgrades, which is where Home Depot and its growing revenue, profit, and dividend come in. The retailer has increased its dividend for 13 consecutive years. Like I've said before, I tend to think of Home Depot as the dividend depot. This company is that good at depositing ever larger dividends straight into investors' brokerage accounts. The 10-year dividend growth rate is 20.3%. Even the most recent dividend raise came in at a stunning 15.2%. And the stock yields 2.4%, so you don't need to sacrifice a lot of yield in order to access that monstrous dividend growth rate. With the payout ratio sitting at 45.8%, Home Depot has plenty of room for future dividend raises. This stock's 23% slide has created what I think is an appealing valuation on a wonderful business. Home Depot just screams quality right across the board. Despite that, the market has been ruthless. This stock was $417.84 at its 52-week high Now, it's sitting at right about $320. Our recent full analysis and valuation video on Home Depot showed why the business is estimated to be worth nearly $350 per share. This is one of the best retailers on the planet, and if your portfolio doesn't already have shares in it, consider changing that. The fourth dividend growth stock to cover today is Mueller Water Products Inc., stock ticker MWA. Mueller is a water infrastructure products company with a market cap of $2 billion. This small cap company flies under the radar. It doesn't get a lot of press, but it's in a space that I've been personally very active in. Water. I've said a number of times now that I think water will be the liquid gold of this century, just as oil was the liquid gold of the last century. That's based on both its importance to life and the increasing difficulties and cost to access it for a lot of people out there. Demand isn't going anywhere, but supply starting to become constrained a bit. That sets up almost any water-related company to do well and increase its revenue, profit, and dividend for years to come. The water infrastructure company has increased its dividend for 8 consecutive years. Now, Mueller doesn't really wow me in any one area. The 5-year dividend growth rate is 9.1%, but recent dividend raises have been in the 5% range. The stock's yield of 2.1% is good, but it's not great, and the payout ratio of 50.8% is nearly perfectly balanced between retaining earnings against rewarding shareholders, so I do like that, but it's also not some super low payout ratio. I guess what I like here is the total dividend package, which comes wrapped inside of a business total package that doesn't really have a lot of downside risks that I see. The stock's 22% drop from its 52-week high may have created a nice entry point here. The business is not growing super quickly, nor is the stock's yield super high, so you want to gain your edge on the valuation side of things, trying to capture that potential upside. This is the kind of business where valuation becomes even more important than normal. The stock's 52-week high of $14.62, expensive, but down here at below $12, I think it makes a lot more sense, keeping in mind that we're talking about boring but necessary stuff like valves, fire hydrants, pipe connections, and metering products. The P/E ratio of 23.5 still isn't exactly a mouth-watering number, but it is quite a bit lower than its own 5-year average of 27.1. The sales multiple of 1.4, which compares favorably to its own 5-year average of 1.9, tells a similar story. Back up the truck? No, but it's at least worth having on the radar. The fifth dividend growth stock we have to quickly talk about today is Whirlpool Corporation, stock ticker WHR. Whirlpool is a multinational manufacturer and marketer of home appliances with a market cap of $8 billion. This is one of those business models that even a child can understand. We're talking about home appliances such as refrigerators and washing machines. While a lot of people like to lose money in things they don't understand, I'd rather make money in things I do understand. Of course, there's more to successful investing than just understanding what you're buying, and now isn't a really great time for an appliance maker like Whirlpool, but that's why we're talking about it here. If everything were unicorns and rainbows right now, the stock wouldn't be down so much. That said, Whirlpool is still a dividend machine. The appliance company has increased its dividend for 12 consecutive years. Some of Whirlpool's dividend metrics are out of this world. The 10-year dividend growth rate is 12.8%. If that weren't impressive already, the company's most recent dividend increase came in at 25%. Plus, the stock yields 4.8%. How often do you see a near 5% yield paired with a double-digit dividend growth rate like this? Almost never. Based on the company's most recent non-GAAP earnings per share guidance, the payout ratio is 36.8%. The one thing to be aware of here, though, is that GAAP earnings per share and non-GAAP earnings per share diverge more wildly than I'm used to seeing, and that's a bit of a red flag to me. Otherwise, outstanding dividend metrics. This stock is down nearly 40% this year. It's been absolutely crushed. Is that an opportunity? That's a good question. The stock's 52-week high of $245.44 has completely evaporated. Shares are now trading hands for about $147 each. This drop has encouraged me to bring up this name for the first time ever on the channel. Every basic valuation metric here is trailing its respective recent historical average, and by large margins at that. The forward price earnings ratio based on that non-GAAP guidance is only 7.8. That's cheap. But sales and earnings are falling Personally, I'd wait for the business to show real signs of stabilizing before jumping in. The stock could certainly rebound before that happens, but I'd rather be a bit late than way too early. Either way, I do think Whirlpool is at least worth looking at for the first time in nearly 3 years. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about these 5 dividend growth stocks that are down 20% or more from their recent highs. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you can benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.